Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I am going solo, and I think I should spell out for you folks what exactly I have meant recently when people are asking me about my thoughts on the Genius Act. And I've said, somewhat tongue-in-cheek, but also seriously, that, this looks like it was written by the conventional bankers so that US dollar stablecoins wouldn't put them out of business. I say that somewhat cheekily, but there also is an element of truth to that. So let me just spell out the economics in terms of money and banking of what I mean by that statement to help people understand the big picture. And primarily this is pedagogical because I've seen a lot of misconceptions, particularly on social media, about how modern banking works, especially in the era of government-issued fiat money. And so I think this discussion will help clarify in your own mind how these things work. Okay, so again, the context here is the U.S. has passed versions of what's called the Genius Act that has to do with the regulatory framework for stablecoins featuring U.S. dollars that are marketed to Americans. The particular component of the Genius Act that I want to focus on is the element of the backing for these stablecoins. So a stablecoin, what is it supposed to do? It is a blockchain-based digital token, just like the way Bitcoin or Ethereum is, except the function of a stablecoin, as the name suggests, is that it's supposed to maintain parity with some other asset. So the most common example is the US dollar. And so one USD stablecoin, even though it's not literally the same thing as a US dollar, it is supposed to be economically equivalent to it. That's its function. And so that's why people hold it. Where did these things come from? Let me just take a moment to talk about that. Originally, the reason people were interested in Bitcoin was, there are two main reasons. One was they wanted to be able to send payments, particularly like micro payments, around the world without getting charged a large fee. So the idea was that, like if you go read the Bitcoin white paper, for example, right? The idea is, somebody goes and works abroad and they want to send money back home, what's called remittances. And right now, the conventional banks and whatever, they're gonna charge you a pretty hefty overhead just to move money around planet Earth. And so that was one of the promises of Bitcoin early on, believe it or not, was to be able to send perhaps even small bursts of payments to people in a very low-cost manner. All right, so there's that element. But also, a lot of people who were dissatisfied with government-issued fiat money, right? So money that's not backed up by gold or silver or anything like that. Just, it is what it is. The government doesn't promise to redeem it for anything. And it's basically just the unwillingness of the political authorities to foist unacceptably high price inflation on their people that gives them some moderation when they're running the printing press, right? And so when you're dependent on the political class backing off of what's in their narrow self-interest out of general concern for the public, usually the results aren't too good. And so for people who did not like the monetary regime of planet Earth as of 2007, Bitcoin was, to those people, it gave them the promise, we have this new type of money that's produced by the market and the voluntary private sector outside of political channels. Hey, nobody's in charge of Bitcoin, even if they wanted to be, so it can't be corrupted. They can't inflate it, right? Because it's 21 million is the absolute most Bitcoins that will ever be mined. It's mathematically built into the protocol. And this is the way to have a decentralized money that's free from the corruption and inflationary havoc of government-issued fiat monies. So that was why a lot of people, especially like libertarian types, early on were very interested when Bitcoin came on the scene. So it's ironic that some of the biggest, in terms of market cap, digital tokens out there now that exist on blockchains are US dollar stablecoins, right? That one might have thought prima facie, why the heck would anybody who likes digital, particularly, it's not just digital in the sense of like, if you log into your Bank of America checking account online, there's a sense in which that's digital money, or even PayPal is digital money, but those are all denominated in US dollars or euros or whatever, depending where you live. But it's perhaps initially ironic that people who want to get into blockchain-based assets and monies or currencies might hold a huge amount in terms of market value of digital tokens that are tied to the fate of the US dollar. And also to a lesser extent, the euro and so forth. So it's like, what's the point of doing that? If you want to hold US dollars, you can go ahead and hold US dollars conventionally. What does the blockchain give you, right? So that might have been the thinking. And I bet you if you asked a bunch of Bitcoin enthusiasts as of 2010, hey, do you think in the future there's going to be hundreds of billions of dollars of market cap worth of digital tokens that are on blockchains that maintain parity with the US dollar? I'm guessing they would probably have said, no, what would be the point of that? We're trying to get away from the dollar and going into something dependable and solid and hard money like Bitcoin, right? So one of the answers to that is people who hold large portfolios of cryptocurrencies, Bitcoin, Ethereum, and so forth, other ones. The promise of that is that they might have great appreciation, especially in the long run. But the downside is they can be incredibly volatile. And so for people who want to, like if you're rebalancing your portfolio periodically, or just for whatever reason, if Bitcoin goes way up, for example, and you want to, quote, take some profits, then the existence of US dollar stablecoins allows you to, I put in originally $1,000 into Bitcoin. Now it's worth 80,000. I want to take 20,000 off the table and just set that aside so I can't lose that if Bitcoin crashes. And so what you would do is sell off $20,000 worth of Bitcoin and go plop it into stablecoins. And so that way you can keep all of your wealth on the blockchain rather than, because before stablecoins came on the scene, what would you do in that situation? You could sell your Bitcoin, but then you would have to have that turned into actual currency, like in a regular checking account. And so that would get withdrawn, going through an exchange or whatever. So anyway, it was just a laborious process to go in and out of or between the blockchain world of digital tokens and the conventional world, right? So this was a way you could sort of reduce the volatility and, quote, go into cash with some of your holdings without actually getting out of the crypto or the blockchain space, okay? And then now more generally, as just blockchain-based finance becomes more and more mainstream, there are people who just realize, look, for all the reasons the blockchain offers convenience and accessibility and transparency and so forth, now I think more and more institutional money managers are realizing, to the extent that I want to hold something that's, quote, cash, I no longer have to have just a checking account that has its limitations. I can just, have it be in the form of stablecoins. All right. And also, too, people around the world who, if their local currency is losing value rapidly because of rampant inflation, if there's political turmoil, whatever, just having US dollars, even if they're not earning interest, for those people, that might be a very valuable asset, right? Like if your local currency is running at 30% consumer price inflation year after year, just holding dollars means there's a sense in which you're gaining 30% for something that's very dependable. Okay. So for all these reasons, there's lots of applications, and stable coins, particularly those tied to the major the major global currencies like the US dollar and the euro and so forth, they're really coming into their own. They're going to definitely have a large and growing presence in the financial sector of planet Earth going forward. Okay, so that's that. So the Genius Act, one of its major elements is it's saying anybody who wants to sell such stable coins to Americans needs to demonstrate that they are backed up 100% by things that are very either literally equivalent to or similar to US dollars, right? And so that the idea being, we wanted so that the people who are holding $10,000 worth of stable coins that they can be reasonably assured that what they're holding actually could be turned into 10,000 US dollars if need be. And so that they can rely on that. And so how do you ensure that is you say, oh, the entity that's issuing these stable coins, they need to have reserves. They need to have assets backing up the outstanding stable coins that are held by various members of the public, in their wallets. And in particular, the Genius Act says, at least the versions that have passed, that you can either have like an actual checking account balance in a reputable bank, or you could have treasury securities. But even there, it can't be like a 10-year treasury. No, it's got to be the maturity remaining on the security that you own has to be 93 days or less. All right. So in other words, you don't have to literally just hold T-bills. You can have a 10-year treasury, but the point is it's got to mature in less than 93 days. Like, so it was issued more than 9 years ago, if you get what I'm saying. All right. So that's the way the actual language of the bill. All right. So finally, now we're setting myself up for my point and my observation that, it looks like the conventional banks had a hand in this legislation to make sure that stablecoins don't put them out of business. What I meant by that is regular banks do not have anywhere near those stringent reserve requirements for their checking accounts. So that's where I'm going with this. Let me just take a little bit of a detour to explain historically how banks worked back in the days of gold and silver being the money, because I think that's conceptually the way to really see it. And then we introduce the complication of Richard Nixon closing the gold window, and then we'll bring it up to the present. All right, so let's take a little historical detour. Again, this isn't merely for the sake of a history lesson. I really do think thinking through how banks work back when the actual legal money were gold and silver coins, I think that's the way to not get screwed up in your head about these legal and economic distinctions. Okay. So in the United States, and a similar story would apply in other countries, but I know the history of the US very well on this topic. From once there was that American Revolution, the colonists won their independence from Great Britain. They had the Articles of Confederation, then they had the US Constitution. So that early republic, an early coinage act, it defined the US dollar. And by the way, the colonists used all sorts of different monies. So originally, they were subject to the UK government, the crown. And so they used pounds, sterling, and whatever. But in day-to-day commerce, the colonists used monies from all over the place. And a popular item was the Spanish thaler, which just got eventually pronounced as dollar. Right, so the American colonists were used to using dollars in day-to-day commerce. And so that's why the new government decided to adopt the dollar as the official money of the United States, this new country. Okay, so the original legislation, the Coinage Act, literally defined the US dollar in terms of particular weights of gold or silver. So it was what's called a bimetallic standard, meaning because there was two metals. All right, so to be clear, it wasn't that the authorities at this initial phase printed up green pieces of paper that said, 10 US dollars on it, and that if you went and turned it in a vault somewhere, they had some gold and silver bullion that they would give you. That's not how it worked. No. Originally, from the original U.S. Republic under the Constitution up until the eve of the Civil War started in 1861 in the United States. For that whole stretch, from the 1790s up through 1861, the U.S. federal government did not issue paper currency that was legal tender. No, the only official money were gold and silver coins. And so, for example, there would be a $10 gold eagle coin, right? And it would be stamped, 10 US dollars, and it was a coin that had a certain amount of gold in it. And so you could take that and divide by 10 and say that's how much gold represents $1, right? So, but the way they did it, again, was they gave specific definitions of the coins, or a $20 gold eagle would have twice as much of the gold in it. Whereas a $1 coin was defined as a certain weight of silver. And then a quarter of that would be a $quarter, and that would only be 25 cents in terms of what was stamped on it, right? So, okay. So that's how it works. So there was gold and silver coins, the bigger denominations being the gold and the smaller ones being silver. And that was the actual money. Economists might call that the base money. Okay, that was legal tender, right? If you contractually owed someone $20, you could give them a $20 gold double eagle piece, and they would have to accept that. So you legally extinguished your debt. The U.S. authorities did not issue paper currency. Moreover, the Constitution expressly forbid the state governments from issuing anything other than gold or silver coin as legal tender for the payment of debts. And part of the reason is during the American Revolution, they had a bad experience with what was called the Continental, right? So there's a phrase, not worth a Continental. So it was the Continental currency, right? Because the Continental Congress, to pay the troops and whatever, started running the printing press and issued this thing called the Continental currency, okay? And it was inflationary and it didn't go well. So because they had a bad taste in their mouth from that experience, the people writing the Constitution said, we don't want the state governments issuing their own paper currencies. We want to protect Americans from that. So no, the only thing that is valid is that you can make payment in terms of the legal tender for the satisfaction of legal obligations denominated in US dollars. The only thing that's acceptable that the governments can insist on is gold and silver coins. Okay. However, from all this, you should not take away that I'm saying Americans didn't use paper notes in commerce. They did, but they were not green pieces of paper issued by the federal government. Instead, the paper notes were issued by the banks, and these were regular commercial banks. There were the closest things to what we would call a central bank in the modern sense. There was the first Bank of the United States and the second Bank of the United States. That latter one famously was, quote, killed by Andrew Jackson, if that's on your radar in terms of U.S. history, that Andrew Jackson was a staunch opponent of centralized financial power. And so he went out of his way. That was one of his signature issues. He actually had that put on his gravestone, that something like, he killed the bank, something like that. That's how proud Andrew Jackson was of him doing this, that he did not renew the charter of the Second Bank of the United States when it came up for renewal when he was in office as president. Okay. But neither of those banks, even though if you read the history books, people will point to them as precursors of the Federal Reserve, neither of those things, even though they were chartered by the federal government and so forth, their notes were not legal tender. Okay. So I just want to be crystal clear about how limited this was. Even the things that people point to and say, yeah, that was kind of like the Fed before the Fed. No, the paper notes, even issued by the Second Bank of the United States, those were not legal tender. So if you owed someone $100 and you had a note issued by the Second Bank of the United States that said, the bearer of this note can turn it in at any of our branches and receive $100 worth of gold or silver coin, that's what the thing was. It was like a claim ticket issued by the bank saying, upon demand, anybody can turn this in at our branches and we will give the bearer the same amount of US dollars worth in gold or silver coin, whatever you want. Okay. And so, again, specifically, I'm just trying to drive home the point here. If you owed someone $100 contractually and you tried to give them a note issued by the Second Bank of the United States, that person could say, no, I don't want that. And you couldn't just say, well, hey, I paid you. Here's $100. Our contract says I owe you $100. This is $100. There you go. No, that person could, if it came to it, go to court and say, this guy owed me $100. He's trying to give me this piece of paper. No, I want actual money. And the court would say, yes, he's right. You have to give him 5 double legal gold coins because they're marked $20 each. And that's how you give somebody $100 legally. Okay. To be clear, if the person were happy with it, they might accept it. They say, yeah, I trust Second Bank of America notes. Go ahead. Because I know I can use this. Merchants around town accept this. That's fine. So it's not that you had to go get gold coins or silver coins to pay your debts. But the point was, if the person insisted, you couldn't force them to take the notes as if they were the same thing as the actual legal money of the land. Okay. So that was the true up. And what happened in the Civil War is the federal government printed what were called greenbacks, colloquially. All right. So they were pieces of paper that were green and had, various denominations of US dollars printed on them, and they were not redeemable for gold or silver coin during that stretch. All right. So anyway, that was the first period where the new US government clearly issued things that were supposed to be US official legal US dollars that were pieces of paper. Okay. So now let's just, for our purposes here to understand stablecoins and so forth, let's just think through, what does that mean when a bank is issuing banknotes and that's circulating in the community as a type of money? All right. So like I say, if the bank were reputable, it could just be a regular private commercial bank. It doesn't need to be the second bank of the United States. That's just the most obvious example when it was functioning. But just any bank, if they had a reputation in the community, there's certain advantages to using paper notes, right? You don't want, if you have to go buy something expensive, you don't want to walk in with a big bag of coins and clang them on the table. For one thing, you might stick out. People might rob you if they know you're walking around with a bunch of money in a bag. But also, it's heavy, it's cumbersome, so forth. So just for all the reasons that you right now in your personal life, to have a bunch of bills, paper notes in your wallet or your purse, same thing back then, particularly for large purchases. So there was a role for that, particularly among wealthy members of the community. And again, the way it would work is you could go to a bank, give them gold or silver coins to deposit them, and then they would give you notes in exchange. And so, you'd give them 10 $1 silver coins, and they might give you 2 $5 banknotes. And to be clear, these notes were not interchangeable. Like each bank's notes had information pertaining to that bank. So it'd be sort of like gift certificates in our modern sense, right? Like a Walmart gift card doesn't look like a Best Buy gift card. You get what I'm saying? All right. And so likewise, back then, the notes, it was clear which bank had issued the thing. And so you might, if someone just took out something with crayon, wrote $10 from Joe's bank or Bank of Joe or something and tried to buy something with it, the merchant might just say, "What the heck is this? I don't recognize that." They might only accept notes from banks they'd heard of. Okay. So that was how it worked. And you could see the only way the notes would circulate at par, meaning a note that had on it, "This is good, the bearer of this can get whatever, $10 in coin from any of our branches upon presentation," a merchant who's selling $10 worth of stuff would accept that note in exchange only if the merchant thought, yeah, if push came to shove, I really could go turn this pretty easily into $10 worth of coin. All right. If there was any serious doubt about the redeemability of the note, they either wouldn't accept it at all or they would accept it at a discount. They might say, "You know what? Because I'm not sure if that bank is going to honor this, this stuff that if you gave me 10 $1 silver coins for it, I would sell it to you. But if you're trying to pay me in banknotes, I want $13 worth." You might say something like that to adjust for the risk of redemption. To be clear too, it's not so much there that you would think, oh, there's a serious chance that bank's going to fail and this note's going to be worthless. It's more that there were periods where if there was a financial panic and there were runs on the banks, that the banks might suspend redeemability or redemption. Right. So it's not that the bank just said our notes are null and void. They would just say, yeah, for the next month, we can't honor our if you show up and say, "Here's the note you issued, give me the gold." So we can't for a while. Just come back to us. That would be the way they would typically do it. It was more like the inconvenience and the uncertainty. It wasn't so much like buying a junk bond and the company might go down. Okay. Just to understand in terms of why they might accept them at a premium. Okay. So now that I've laid all that out, I think it's pretty clear to see how that worked and that the business model of the bank, to the extent that you get you're a trusted name in the community, in practice, people know that, yeah, you can go in and redeem your stuff. It's sort of this paradox that so long as the banks are always willing to redeem, and that anytime somebody walks in and says, "Here's the note, give me the gold or silver coins," that they can get it right away without a hassle, then that makes the public less likely to exercise that option. Right? The more certain they are that these notes are as good as the actual money, then you can just use the notes. That's sort of the beauty of it. Ludwig von Mises has this passage in The Theory of Money and Credit where he's explaining that claims to money are very interesting and distinct from other types of claims, right? Like if you have, like you go to a restaurant and you check your coat and they give you a claim ticket, and it's like, oh, this ticket entitles me to my coat. And the point is, here, I'm paraphrasing what Mises said. He didn't use this particular example, but this was the spirit he was saying. It's not like you could just say, you know what, this claim ticket is just as good as a winter coat, and I'm just going to go outside and wear this claim ticket. That doesn't work. No, you need to exercise it and get your coat, right? So there's no danger in the community of overissuance of coat claim tickets. That's not going to happen, right? Because people aren't going to just perpetually hold the ticket rather than exercising it and getting back the thing that it entitles them to. Whereas with money, it's different. If the community is walking around with these claim tickets that entitle them legally to a certain amount of the base legal money, whatever it may be, in our example, we've been working with gold and silver coins, and that as long as most people in the community don't doubt the immediate redemption option, then you can spend those claim tickets, and they're basically the same thing functionally as the money itself. You want to buy something worth $10, you don't need to go exercise the claim ticket and get a $10 gold coin and then go spend it. You can just hand the merchant that note, and the merchant can take it, and he doesn't then need to go and redeem it either. He can say, well, no, somebody else will take it for me, so why don't I just put it in my drawer, and when I have to go buy something from my suppliers, I'll just use this note. And so the point was, once the bankers realized that was the case, well, then now that gives them an opportunity for profit, right? They can issue more notes than they actually have in the vault. And they can do that. And how would they do it? It would be silly. They wouldn't just like say, oh, let me just print up $100 more worth of notes than we have in the vault, and I'll just go buy something for my wife and give it to her, and that's the end of it. No, because if you kept doing that, there's more and more of your notes circulating in the community, that any one of which a person could go and turn in, and you're going to run out of gold in your vault. So what they would do is they would give loans to people in the form of notes that were in excess of what they had in reserve in the vault, because then the loan gets repaid with interest. Okay, and so if you write up a note for $100 and lend it out to somebody at 5% interest, and then the person does pay you back $105 in a year, and they give you your own notes, like that's how they pay you back, right? You can just rip up the $100 note that you, quote, inflated with the original loan principal, and now that $5 note that you have is yours free and clear. So that just sort of like absorbed it from the existing note issue before you issued that $100 excess loan, if you get what I'm saying. And so that's the way that the interest earnings on fractional reserve lending is how the bankers could earn steady, dependable income that was theirs free and clear. They didn't jeopardize the redeemability of their notes by engaging in fractional reserve banking, so long as on net they earned a positive income from that. So if some people defaulted, that was okay. Like if they issued 1,000 such loans earning 5% on average, and then every once in a while somebody just defaulted. Anyway, they technically owed the bank 105 and they just didn't pay them anything. So long as in the aggregate, when they originally created $1 million in new notes, so long as they got paid back 1 year later, at least $1 million plus some excess, that was fine, because then they could still just destroy the million that they originally created out of thin air, as it were. And then whatever was left, that was theirs free and clear without jeopardizing their reserves. Okay. So again, just like with conventional, as you know, without knowing the mechanics of reserve ratios and whatnot, the banks, it's okay if individual borrowers default on their loan from the bank, so long as the bank's gross rate of interest is enough that even taking the occasional default into account, they still earn a net return. Not only is that okay in terms of their P&L statement, but in terms of their reserves, it's also okay in the long run. Okay, so that's how it worked. So let me now just jump ahead in the interest of brevity here. It's crystal clear. I think you can see how that worked and how banks, so there's a sense in which you could say, well, how much money, how many dollars exist in this community or this country? And you could see why there are different ways of counting it. And you could say, well, what do you mean? You mean like the actual gold and silver coins that have various denominations of US dollars stamped on them and that the law acknowledges as legal tender for the payment of debts? Because that's going to be one number. But you could also plausibly say there's a broader concept that includes all the banknotes that people are holding. Like, they think that's real, right? The people walking around town with various denominations of banknotes in their wallet, if somebody mugged them and stole them, they would be, what are you doing? That was money. They're not going to make these fine distinctions that economists make. But I'm saying, how do economists classify that? The narrower the coin would be what's called base money. Some people might call it M0, whereas M1 is broader, and that includes stuff like checking account balances, even if there's not 100% reserves. If there were 100% reserves, the two would be kind of equivalent. That the goal, if you start out with everybody in the community just holding gold and silver coins, and then you say, how much money do people have? Okay. And then if you say, oh, they put some in deposit with the bank and then get notes of the same amount, and now you say, how much money do the people have? It's kind of the same. They just changed the form in which they're holding it. Where there's a wild card, a loose joint, is what if the banks are allowed to issue more notes that say the bearer of this note is allowed to turn it at any time for $10, but there are more such notes in circulation than they actually have in the vaults. Now the community can hold more, quote, total dollars in the form of notes plus gold and silver coins that are in the pockets of the public than if we just use the narrow definition of gold and silver coins or airtight 100% back claims on them. Okay? And so historically, the bankers have been able to legally issue well above, in other words, the reserve ratio has been well below 100%. Originally in the United States for a long time, it was about 10%. And then actually in 2020, during the COVID lockdown stuff era, I think it was in March at some point, they got rid of it altogether, the reserve requirement. So right now in the United States, commercial banks are not legally required to hold any reserves at all. To be clear, they still do hold reserves, but they're not legally required to. And so if you just understand, so why would they hold any reserves? Again, go back to the gold and silver thing. Forget government regulations or whatever, just business practice. The only way you as a banker can get the public to hold more and more of your notes is if everybody is convinced of their reliability. If a lot of people think they might show up at your branch, turn over the note that, has got your logo on it and everything, it's legit, and say, give me 5, $1 silver coins because I have a $5 note from you. And you say, oh yeah, you know what? We're kind of running a little low today. Why don't you come back next week? Well, now people aren't going to trust your notes anymore. And when people try to buy stuff with them, the merchants are going to say no, and it's going to be a snowball effect. The whole point, the whole convenience of having the notes is they're, quote, just as good as money. And so once you lose that, boom, it unravels very quickly. Okay? So the point is you need the public to believe these things are redeemable upon demand. And so that's why even without government regulation, you're going to hold some reserves because you need to satisfy people. This isn't exactly the same thing, but imagine if you bank with a particular bank and you thought you had $500 in your checking account, but you just learned from experience that when you would go to that bank's ATMs, half the time it would just say, sorry, there's no withdrawals aren't allowed at this time. Like half the time when you tried to actually get your money out, the ATMs didn't work. You would probably switch banks. The whole point, and also too, when you tried to run your card and just buy something as a debit transaction, if it just said, sorry, try again later, you would stop using that bank, right? And you would just hold cash, or you would use a different bank that didn't perform like that. Because the whole point of you not holding currency and keeping your money on deposit with a bank for the convenience of swiping your card or just not having to carry boatloads of cash, but just occasionally hitting an ATM when you were running low, that all goes away if you can't rely on those transactions working when you need them to. Okay? So similar thing here with the gold and silver coins. So now jump ahead. In 1971, Richard Nixon famously severs the dollar's tie to gold. So from that point forward, the base money in the United States were Federal Reserve notes. And so this is something that they misunderstand on social media a lot. A lot of people say things like, oh, the vast majority of dollars being created year to year are from private banks, not from the Federal Reserve. And yes, that's true, but it's not correct to therefore conclude that conventional bank issued dollars are the same thing as Federal Reserve issued dollars. They're not. And the reserves still play a vital role in the financial system in the euro dollar system, if they couldn't get their hands on reserves and get, quote, actual US dollars, those banks could start going down. If the public came to doubt that they really could convert their US dollar claims, you think you're a big wealthy client, you think you have $200,000 in your account with Deutsche Bank. Deutsche Bank cannot create legal tender US dollars the way the Federal Reserve can. So if you began to doubt that what Deutsche Bank says you're holding in terms of, quote, 200,000 US dollars in your checking account, if you came to doubt that you could actually convert it into something more like actual US dollars, then you would close your account with them. You'd do something else. Okay. So the point being, in our system right now, what used to be the role fulfilled by gold and silver coins with various denominations stamped on them now is Federal Reserve notes, green pieces of paper with, Benjamin Franklin and other people's portraits on them with various dollar denominations written on them. That now in our system takes the place of what gold and silver coins used to do. But still, there is the distinction that if you think you have $1,000 in your checking account with Citibank, they don't necessarily have 10 Benjamin Franklins in a vault that they're holding for you. And if everybody who's a Citibank client tried to withdraw and empty out their checking account balances, Citibank would run out of currency. They don't have enough Federal Reserve notes on deposit, or I should say in their vaults in reserve. Okay? And so you see what they're doing with the Genius Act now, to tie this all together, is they're insisting that if you want to issue digital tokens that are transacted on a blockchain that are supposed to be airtight claims on one US dollar, and that's how we want people to treat these things economically. It's not just that, in practice, people shouldn't have trouble converting them into actual US dollars. It's that we want to show they have 100% reserves. And by reserves, we don't just mean assets that have a market value. No, we mean things that are quite dependable, literal checking account balances or treasury securities of 93 days maturity remaining or less. That's what qualifies. You got to have 100% of that to back up your outstanding stockpile of stablecoins. So I'm saying that insistence is way more rigorous than what they apply to conventional commercial banks. Right? If you go and put $1,000 into your checking account, like, you have green pieces of paper, you deposit it at your bank, they take it, and then your checking account electronic balance goes up by $1,000, right? And you're walking around and you check your balance on your phone, or you go to an ATM, put your card in, and check balance, and it shows you, and you think, I've got an extra $1,000 now with Citibank. They can lend out as much as they want, really, but in terms of their business practices, let's say they lend out 900 of it, right? So they no longer have it there. And it's not that they take the 900 and they go buy T-bills with it. No, they can go and give a 30-year mortgage to somebody with that money. Okay, there are other regulations in terms of capital requirements. I'm not trying to make it sound as if there's no regulation whatsoever, but I am saying they did get rid of the explicit reserve requirements. Okay, and so it is true that your commercial bank certainly does not have liquid assets that are like claims in other commercial banks or green pieces of federal paper, Benjamin Franklin's and whatnot, in the vault, or even T-bills or less in the vault backing up all the checking account balances. That is absolutely not the case. Okay, so that's what I'm saying is the Genius Act is requiring stablecoin issuers to be much more dependable and reliable with the redeemability than they insist on from regular commercial banks. And because of that, last point I'll make, that's why, especially as interest rates rise over time and go back to more historically normal levels, whether or not the Genius Act or whatever version they end up passing into law, whether or not it explicitly forbids paying interest to the holders of stablecoins, in practice, the issuers aren't going to have much yield to pass along, right? So that one of the arguments for why fractional reserve banking should be permissible is to say, well, if you want the regular commercial bank to pay you interest on your checking account, well, they have to be able to take the money and go put it to work. They need to take it and go give 30-year mortgages to people, or to invest in 5-year projects that have a certain yield. If you want them to be able to pay you interest on your checking account, if in other words, if you insisted that they keep 100% reserves for your checking account and everybody else's checking account, so that a bank runs impossible and you know your money's there, blah, blah. They can do that, but that you're going to have to pay them. Because how are they going to pay for all the ATMs and all the security cameras and all the bank tellers' salaries and blah, 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 blah. There's a lot of overhead in having this infrastructure to facilitate the convenience of having a checking account. And so for them to be able to give you all those services and on top of that pay you interest, which is what people expect right now, right? The bank has to take your deposits and go do something with it. And they certainly can't just plop it into T-bills, right? That's the idea. So whatever you think of that, I'm just pointing out, notice if you're going to allow commercial banks to do that, but then you're going to insist that stablecoin issuers must keep 100% reserves in something that's T-bills or less, then there's no way the stablecoin issuers can take the deposits from the people who originally want to buy in and say, oh, I want to have $1,000 worth of stablecoins, and they give them whatever, 1,010 or something because of the service fee to get it. Well, with the money that's coming into the coffers of the stablecoin issuer, what are they going to do with it? If they're only allowed to at best roll it over in T-bills, they're not going to earn much yield on that. So there's nothing to share with the client, even if they wanted to. Whereas if, the commercial banks can go pump it into things that have a higher yield, then there is more of a margin and they can share some of that with the depositors. Okay. So anyway, that's just the way a lot of shakes out. So again, here, I've written a lot. I'm very skeptical of the practice of fractional reserve banking. And I think it causes the business cycle. That's one of the contributions of Ludwig von Mises, a dean of the Austrian school, is he thought the business cycle and the market economy was intimately tied to what's called fractional reserve banking, that practice. Okay, so I'm in a weird spot here where I actually kind of don't have a problem with saying, hey, stable coins need to be backed 100%. I'm just pointing out the irony that regular banks aren't subject to that same requirement. And so it's kind of interesting that if, Elizabeth Warren and people like that are saying, oh, to protect the consumer, we got to insist that these stable coins are backed up 100% reserve and things that are very liquid and dependable, like U.S. Treasury securities and stuff like that, and regulated banks that have FDIC protection, blah, blah, blah. Okay, but then it's interesting that the consumer doesn't need such similar protection when it comes to regular banks, that they can go and invest in much longer assets. They can invest in things that are far riskier than T-bills. Okay, well, that's a good place for me to wrap up. If you want to see more elaboration on this, for one thing, in terms of the history and theory of money and banking in the United States, my book, Understanding Money Mechanics, the Mises Institute published that. You can get a free PDF of that. You just Google it. I'll put links in the show notes page. But also, in Infineo, I have a blog post summarizing some of the points that I made here if you want to go see that fleshed out. Thanks for your attention, everybody. We'll see you next time.